My name's James Hughes, Chief Market Analyst here at Scope Markets. So thank you very much for joining us yet again. We continue to run with our webinars and tell you a little bit about how we're going to go for today. Very similar kind of format, of course. The format is that we will be looking at a few markets. Number one, looking at how the markets are performing at the moment. And what we're doing at the moment, the way we're running this is that we're saying we're looking at the markets, and then we're adding in a kind of a technical aspect or something educational into what we're looking at. Now, yesterday we had a brief, just our market update, and then the day before that, I think Monday, was candlestick charting. We were looking at candlestick charting, and there was a key example of candlestick charting yesterday, which gave us a nice little move, and I'll tell you about that in a minute. But then today is Fibonacci's. So we'll look at Fibonacci retracements now, and they're key Fibonacci's at the moment because we look to, whenever we see big movements one way or the other, we then look for another reversal move the other way, don't we? We look for a different move one way from the next, and sometimes it's a case of really trying to pinpoint where that market is going to be. So we will look to see exactly what we get out of there. Now, as always, if you have any questions, please do not hesitate to ask. It'll be really interesting, obviously, to hear your thoughts, and I'd like to make this interactive. This is key that you guys drive what we talk about. Obviously, the discussion points are what they are at the moment. We can't get away from them. But the situation is that we want to hear from you guys. We want to hear what you want to look at, what you want to see, what you want to trade. I will deal with, obviously, the major educational side of what we look at, but what I want you guys to drive this. This is for you. We've all got time on our hands at the moment. We're all in a situation where we're working, or we're working at home. We're doing whatever it is. We're on lockdown, and there's never been a better time for us to look to trade. Look to have a little look at the markets and see what we're going through. So we'll do that today. So let's look at let's look at the markets now. Of course, there's only one headline that we can look at for today, and I actually potentially want to show you that. I want to show you that straight away. Now, if I can find it, hold on one second. But of course, it's the initial jobless claims. That's the key thing that we're looking at. The initial jobless claims have come out, and we were talking about these for a few days, weren't we? We've been talking about these and saying, well, what is the situation? What are we going to get when it comes to initial jobless claims? And jobs are key. I mean, jobs are we can't get away from that jobs are the most important things that we look at in terms of economic performance. And anyone that says, there's a lot of discussion about saying, oh, we should move these here, we should see a different we should see a different move. We should look at PMIs. We should look at things which are forward-looking, like ISM manufacturing, PMI data, and various things like that. However, what is most important? What is most important is the fact that what we look at is jobs. If people don't have jobs, if people aren't employed, they can't spend money, and the economy only works when people are spending money. That's the only time any economy around the world works. And you have two things. You need two things for an economy to work, and that's spending, and the other one is lending. So we need banks to lend money, but we need people to spend money. And if people aren't spending money, then the economy will suffer. So that is the key thing. So let's look at the markets. You can see the sell-off that we've seen here on the Dow Jones. This is an hourly chart, and you can see the sell-off that we had here. This is the big downside movement that we've seen, and it's because the initial jobless claims came out at 6.6 million. So 6.6 million more Americans claiming unemployment benefit this week. So that's new people claiming unemployment benefit. That is a movement of 10 million people. 10 million people within the space of 2 weeks have claimed unemployment, have jumped in unemployment. So that is a massive number. And if you ever wanted to see an indication of just how deep this is going to go, how under pressure these markets are, how under pressure the economies are going to be. And for anyone that says, oh, well, the recession may not be too bad, or the global recession, it's manufacturing is looking all right in China, so I think we'll be okay. Unfortunately, you could just have to look at the situation that we have with these with these different unemployment numbers, and you can see what happened. Now, this is the move on the Dow that we've seen happen over the last 24. Not saying last 24 hours. I mean the last hour. The numbers came out at 1:30, and this has happened since 1:30. So big downside move. Now, yesterday, Monday, we were talking about candlestick charting, and there was a key. I can't remember which webinar it was on. We were talking about it. It was either yesterday in the market update, or it could have been the day before in candlesticks. But there was something that we were speaking about dojis, and there was a doji candle here. This key doji candle came in here. So the downside, big sell-offs in 2 candles. You could see the indecision coming into the market at this area. Hang on a second. Can everybody hear me okay? Could you just let me know if you can hear me okay today? There's a couple of people saying that the sound is not very good. Can you hear me okay, everybody? Yeah, sound seems okay. Thank you very much. There was someone asking me, saying that the sound is not good, but maybe if you close and reopen, then maybe the sound will get better. Thank you everyone for replying there. Thank you. That's great. So we were talking about candlesticks and this movement. There was a doji candle that came in here. Let me just annotate that for you and show you where that was. So it's this one in here. I'm just gonna every time I do that, every time it's this one. I'm just gonna point directly to it. This one, this doji candle. Now this doji candle was interesting, and there's 2 things I want to talk about this, because we had the doji come in. We had previous here where the market had come lower, but if you see this movement here and the shadows on these candles, 1, 2, 3, 4 shadows on these candles, they'd all come lower, but they're all pointing to buying pressure coming in. So yes, they're downside, and yes, this is a very negative candle, but you can see the amount of buying pressure which is coming in here. So it's given us an indication that this was slowing up. Then we saw the doji candle come in. That gave us a little turnaround. Now, what was key? We have this morning star formation, which is 1, 2, 3 candles. So down, doji, up candle. Okay, that's what we're looking at. Now we had those three come in here. Now this movement to the upside. What was interesting here is, yes, there was this movement, but what I want to point out to you is the fact that some people would have said in this situation, okay, when this happens, it's a reversal. Yes, it's a reversal pattern. The morning star formation on candles is a reversal pattern, and yes, the market's going higher. And a lot of people would have said, okay, well then I think as soon as that happens and we're here, that is happening. I'm getting higher. We might come down a little bit more, but then that will probably be the case. Okay, now that obviously didn't happen. That didn't happen because what we saw was the market coming higher, turning itself around, and then falling lower again. Okay, and these 2 candles were interesting because there was a big upside again. This was a worrying candle, this red one, because there was big upside. However, what we should have looked at, and this is something that we're going to be discussing a bit, or we discussed yesterday because we were talking about entry and exit points. Now, the entry and exit points for this were key. Now, because there is so much volatility in this market at the moment, because we're seeing so much in the way of big movement, because there is so much in the way of because there is so much in the way of big movement within these markets at the moment, so much volatility, so much unknown quantities in terms of what we're looking at, then we have to think about where we would be taking out our where we would be getting out of our positions. Now, for argument's sake, with this, I never thought, and I don't think we could ever have thought, that the market was going to go and rally very much higher. And I just want to show you something, just so I know. So basically, I got into this trade yesterday. I was showing some people some trading yesterday, and we did a couple of trades, and we only did very small trades, very small trades. But I got out at this high. And so, you know, a lot of people say, oh yes, well, I got out of the high, and then they will show, then they would say that there was I want to show you the trade. It's in here, so you can see this trade in here. So there's only one lot. Only bought one lot of Dow Jones. Bought at 21.24, which was 21.240, which is the blue line. So we got in late. Okay, we got in late. We were just looking to take a small amount. Okay, so when we broke, we was looking just to take a very small amount of P&L out of this, or just a small movement, you know. And I just want to show you where we came out of this trade. So 21.240 was where we got in, and then we came out at 20. We came out. Our stop was at 21.360. Okay, we in fact came out below that. 21.336 was where we came out, and we took a £96 profit out of that. And it's only very small. I was only showing someone yesterday some very small trades, but we came out at this area. I just want to highlight that to you to say, well, the reason that we came out of that area, the reason that we took the trade out of that at that sort of period, is because these markets are so irrational at the moment. Now, usually in a normal situation, we'd say, okay, that's a turnaround, that's a doji, that's a morning star formation. Markets are going to move higher. I'm willing to go with it. Now, but this at the moment, there's so many movements in these markets which aren't giving us true reflections. They're giving us wild swings in the market. So it was right for us to be cautious. So we were cautious in this area, took out our trade, and there we were, quite happy. Okay, so we were quite happy to take our profit. And this is the key thing when it comes to trading. We look at this. If we'd have kept that in and run it, we would have had a stop in, of course. Our stop would have been in. Our stop would have been at the low of this candle. Okay, which is why on candlestick charting, the shadows or the wicks, whatever you like to call them, they're great for placing stops. Okay, you put your stop at the top or the low. It's a long way down from where we were. So 21.240, our stop on this downside would have been all the way down here at 29.64. Okay, so a good few hundred points away. So we would have lost out quite aggressively. So what we obviously decided to do with this was to actually come out at this high. So because these markets are so erratic, and you can see this movement again here. You can see, yes, we came off, got to the low, started going higher, but now we're under pressure yet again. We're falling lower yet again. So these markets, Wall Street and stock markets, are under pressure. And just because now these weekly jobless numbers are becoming a thing. Now, jobs are key. Yesterday, we've had 3 sets of economic data coming out from the US, and there's going to be 3 sets of jobs data. Yesterday, ADP payroll, negative 100,000. Today, initial jobless claims, an increase in jobless claims, so unemployment benefit of 6.6 million. To put that into context, I've shown you this before. What we get usually is around 240,000. Anywhere between 100,000 and about 500,000 is the max usually. 6.6 million new people claiming unemployment benefit. The recession is going to be deep. Now, what do we get tomorrow? Well, tomorrow we get the non-farm payroll. Now, this, for the first time ever, the non-farm payroll tomorrow will not be as important as the initial jobless claims, because the non-farm payroll is showing past data. Okay, it's yes, it's showing March, but it's also showing a time when the whole of March wasn't that impacted. So it's going to be very, very important to see what that number comes in at. We have no idea. That's going to be the key thing. Now, let's look at Fibonacci's. Okay, let's look at our fibs, because this gives us an actual key area, a way we can spot this and way we can look at it, because let me get rid of this. Okay, so this gives us a key thing. Now, when we're looking at fibs, now Fibonacci, to let you know what Fibonacci is. Fibonacci is Leonardo Fibonacci was a whatever century mathematician. Okay, all the way back years and hundreds of years ago. And what he discovered was this magic ratio. Okay, so a magic ratio where, and I'm just trying to find a description for you, but a magic a magic ratio in which you could basically see the building blocks of life. And Leonardo Fibonacci said that this formation, this ratio of 618 was in the building blocks of everything. Okay, it was in everything within the world. So the way that people would also look at Fibonacci's is they would say that Fibonacci's were, if you were to measure I can't remember what the whole thing is now, but if you were to measure the width of, so if you took a butterfly and you measured its wingspan and divided it by the length of the body, the overall calculation comes in at 6.18 or 618. So that's the key thing. However, and you can tell that I'm not, I don't pay much attention to what the whys or the wheres, because we're really, as traders, we're not really that bothered, are we? We don't care that much about where the we don't care that much about where the market is going in terms of why these things come in. We just want to know how we're going to use them for trading, don't we? That's what we want to use. So basically what we do is we look at a movement in a market. So let's look at Dow Jones on a daily basis, okay? Look at this daily chart. Okay. So we have a daily chart here, and let's look at the movement that we have in place, okay? So we've seen a big move from this high point to this low point. So the sort of Fibonacci that we will use in this situation is the most common use of a Fibonacci ratio, and that's Fibonacci retracements. Now, Fibonacci retracements tell us that if the market has moved from this point to this point down here, it will give us an extension to say where the Fibonacci ratio percentage numbers of retracements are on our charts. So for argument's sake, what we will look at is we will say, if this market has come down this far, inevitably at some point it's going to come back. But where will the levels be that will be important as we go up here? Well, we look at the Fibonacci sequence and we say, well, the most important number in the Fibonacci sequence is 61.8. 61.8. So what we would say is that we would look for the 61.8% retracement of this move on the upside. The easiest way to show you this is to add it. So you go to the top of your chart here and there's an F with some lines. That's Fibonacci retracements. Okay. We drag from the high to the low. And within there, our Fibonacci will put, our retracements will put levels in. And you can see that the key numbers within our Fibonacci retracement are 23.6, which is in the retracement, the numbers, 38.2 in the ratio, 50, 61.8. As we go higher, there are more, and we can add more in by going in here, Fibo properties, Fibo levels, and we can add in whatever it is that we want. These are the ones that are in at the moment. Now, you can add whatever ones you want to add in there. So, I think the 70, just trying to find it here. So in terms of the golden ratio, so the ratio of numbers, what we look at is all of these numbers, the Fibonacci sequence going through, and then we look at those various different levels. And we can add various different ones in if we want to. However, the key ones from our trading point of view tend to be, there's two of them really, 50, 38.2, 50, and 61.8. Those are the three which become most important. Now, on this chart, you can already see that 38.2, and let me just make our Fibonacci a little bit more prominent here because it's hard to see. Okay, there we go. That's better. Okay, so we can see this now. 38.2, what it says is that when this market moves lower, and we always put our Fibonacci retracements on after the initial big move. So we see a big move, we see a bottom establish, and then we go, where is the market going to retrace? Well, the situation at the moment is that we are retracing to the 38.2% level. 38.2% retracement of that move. Now, that's not to say that this will be the final low, but it's saying that 38.2% is our key level. Now, what it's also saying is that this market has come out of here. It's broken 23.6. So we would then disregard 23.6. So we look to 38.2. Okay, so we look to our 38.2% level. And we would just use that 38.2% level as a form of support and resistance. Very simple. A very simple form of support and resistance. Now, and you can see that that's worked. We have seen a brief breakout on the upside. But one thing that we look at on Fibonacci is which is different to the way we look at things when it comes to normal support and resistance, is we have to give it a little bit more leeway. We have to give it a little bit more space. So where you can see that breaking out on the upside, where you can see that brief breakout, then that shows us this breakout here. You're able to give this a little bit more room to breathe. Now, I would always say that you should give these things room to breathe when it comes to normal Fibonacci, normal support and resistance levels as well, because I'm not a big fan of following the textbook to the letter. I feel that if you follow the textbook to the letter, then you will end up never placing a trade. I've said this to you before. So looking at this, you can see that the 38.2% level has acted as a form of support and resistance. Now, what we would say with this trade is that we would say, from looking at this, we would say, number one, very simply, that this market has now started to act as a 38.2, as a support level, a resistance level up here. So we would say that if the market comes back up, we expect it to go to that sort of level, back up to that level. And if it does go from there, we expect it to potentially react by coming lower. Okay, that's what we would say. We would also say that if that doesn't happen, if we break, so if this market was to come up here, and let me just change our color for a second. If this level was to come up here and break, the next level we would say that would become important would be the 50. Now, we would also have to use various different levels that we have within the market already. So we have a level in here, don't we? Where if I just get rid of this for a second, we have a level in here, which is this high. Oh, that color's terrible. We have a level in there, which is that high that we're looking at there. Let's just change that to red, which is 23,117 or 23,120, if you like. So we do have that high. But we say that because there's not many touches of that, and there was a couple of touches down here, so this level is definitely more important, the 38.2% retracement, then the market would move to 50. Now, when that happens, that move to 50, all that's telling us is that what we expect that to be is another form of potential resistance on the upside. So another level. Now, there's no getting away from the fact that the most important level when it comes to Fibonacci's are not the 38.2, not the 24.6, not 23.6, not the 50, but it is the 61.8. The 61.8% level is the most important one. So where we would really, really look to see this sort of movement is if we did this. The market did rally higher, came up to this 61.8% level, and that would be our key area of resistance on the upside. So that's the sort of area that we would look at. That's where we'd have to keep an eye on these markets. Now, these fibs are giving us key indicators, okay? And people say, well, I don't like Fibonacci retracements because they're a self-fulfilling prophecy, because everyone's looking at them. Perfect. If they're a self-fulfilling prophecy and everyone's looking at them, that means that we're in a situation and we're doing the right thing. Okay? It means that we're doing the right thing. We're doing the right thing about trading. We're doing the right thing about where we're and looking at the right levels. Okay? So that is why that becomes then important. Now, we use other things around that. So we could obviously use what we do once we've got our positions in place. This is a daily chart, isn't it? We know what this looks like on the shorter term. And let's go back to that. Let me just clear down all my drawings here. But let's go back to that. Let's go back to what this looks like on the short term. Let's go back on that hourly chart. Whoa, whoa, whoa. What done there? Whoops. Excuse me. So let's go back to what this looks like on the daily chart, on the hourly chart. We know that that situation is here. We know that these are the moves that we've seen, and this was what we were talking about the other day with our doji, and we know that we're breaking out below. This 23.6% did start acting on the downside, but we know that these highs are over here, okay? Let's go on the 4 hourly and just quickly have a little look at what that looks like from that point of view. Take this back out a bit. You can see quite clearly that there is a key double top area at the 38.2% retracement. That 38.2% has a clear double top, and that's giving us a real indication. Now, there's been some quite nice technicals around this at the moment, isn't there? There's been quite some lovely areas where the market has broken out. So this trend line on the 15-minute chart, let me take you in on that 15-minute chart and just take you back to that. So on my chart is not enjoying itself at the moment again. So this was quite, and your levels tend to move a bit, but you can see this was quite nice. A breakout was very aggressive. So if we were just looking at our narrowing formation, and again, if we looked at that on an hourly, this is a much smaller data set, but you can see that there was a narrowing formation from one side to the other side. The upside touch here, the downside move here, and then the breakout on the downside was quite interesting. Okay, so there's been some real nice technical areas on this, but something which is giving this similar situation at the moment is this Fibonacci retracement. Now we can add these onto a whole host of different areas. Okay, fibs can be added into a whole host of different areas. As the US just officially opens now, what can we see with this market happening? So we're just into the US Open. We're seeing this come back a bit. We're seeing this start to come back. Let's look at the half an hour because we've got a new candle on the half an hour. So markets opened, starting to play around. Starting to play around a little bit here. Starting to push higher. Always going to be the case after such big sell-off. but market's looking pretty negative. Remember, we had a 900-point down day yesterday. 900-point down day for these markets yesterday. Markets were up earlier, have since given back all of those gains on the back of that that poor initial jobless claims number. So interesting to see where we are, to see what that situation is going to be. It's a big sell-off down there. But these fibs can work on anything. I'm just going to go through some of your questions here now. So I'm just looking at one of them here, what the major entry and exit levels we looked at that, the golden zones. So the most commonly used, yes, we've covered off those few things there. So 61.8. But let's look to add this onto something else. Let's jump out here and add this onto something else. See, my charts are struggling here on my Wi-Fi. Let's look at let's look at something. I'll tell you, let's look at something. Let's look at Aussie CAD. Aussie CAD's quite an interesting one, actually, because let's put my template on here. Because this is a commodity-based currency. So Aussie CAD's quite interesting because both of them are dominated by the oil price. And oil has been very, very volatile, hasn't it? And it did start rising on the back of claims yesterday between the US, Russia, and Saudi Arabia that there would be a deal on output. But that kind of has been going away a little bit because we've seen the movements over the last that's been a situation where we've seen real movement in here. So interesting to see how that plays out. But again, we look for big moves daily. Where did this come to? Maybe it came to 61.8 because these don't always work. Remember, let's have a look. So here's the high. We'd probably look at this high if I'm being honest. Oh, it doesn't. So we saw a breakout of this 61.8. Did it work from the previous one? It did work from this high. So if we look at this high, and again, we have to remember that we have to give these things some leeway. Market breaks, yes, but comes back lower instantly around the 61.8. Okay, so around that 61.8. So you can see that there is a turnaround from that point of view. And these sorts of things happen all the time, but they're key in terms of giving us an indication of where the market is going to go. Okay, giving us an indication of where these markets could potentially turn around when we see a change. Okay, when we see a change in these markets. So let's take this out. Turn around. Let's look at the fib, even though my charts are starting to struggle. Let's look at the fib. This looks like it worked quite nicely. Look at this one. Look at cable. Absolutely perfect. From the high to the low, the Fibonacci 61.8, that's where the market held up on the daily chart. So that's key. Another key indication that these Fibonacci retracement levels do work. Okay, so very, very interesting turnarounds in a lot of these areas. Okay, so I mean, when we look at how these perform, it's not just on the longer term time frames that we can find these. We can put Fibonacci's on anything. We can put them on any time frames at all. Obviously, the more volatile in the time frame. So basically, the shorter you go, if you go very short term, then you're going to be a little bit more under pressure. Okay, so you could well be a bit more under pressure if you go that little bit short term. You could well see under pressure markets or under pressure levels here, because there are big movements which are causing potential issues, so big movements causing potential issues and breakouts. But the longer term, the obviously we still get erratic movements like we're getting at the moment, but they're not massively breaking out in the space of a couple of minutes or so. So you can see where there are areas. Now, in terms of Fibonacci, there are a lot more. There are Fibonacci arcs, there are progressions, there are extensions, there are all sorts of different things. And if we went and covered all of them, we would be here for a long period of time. But for now, I think we will leave it at that. Guys, thank you very much as always for coming and listening to the webinar. It's excellent to continue to see you guys turning up on a daily basis. We will be putting more webinars in for next week, so please feel free to send me an email to let me know exactly what it is you want us to cover. If you would like to open a trading account, if you don't have a trading account with us and you want to open a trading account, please do so. You will get more in the way of materials, webinars, seminar invites, various different things if you are an actual client and you deposit $250 into your trading account. But apart from that, guys, thank you very much for your time yet again today. And I will speak to you again, hopefully tomorrow for our last session of the week. Thank you very much, and I'll speak to you tomorrow.